Season's greetings to you, the clients and partners of Hyland Financial Planning. Will, Douglas and I are investment advisors to many Hyland Financial Planning clients, and each quarter we prepare an economic update, presenting our views on the world economy, share markets and other investment classes. We've just completed our last economic update for the year, so as well as reaching out to you to wish you a safe and festive holiday season, I thought we might include a quick review of the year that was and some thoughts on what might be to come in 2020. This time last year was a very challenging time for markets as we saw a deep correction through the December quarter. Very pleasingly, share markets have bounced back strongly this year, with the Australian and US share markets both rallying 20% plus off those lows which they set at the very beginning of the year. Dividends have been strong again, and some stocks like BHP have paid special dividends over and above their ordinary distribution, which is fantastic. The theme for this year was lower interest rates. Here in Australia, we've seen 3 cuts, and this has been very supportive of share markets. While creating a better environment for share markets, lower interest rates have pulled down some of the income returns to our fixed interest investments. And going forward, we are suggesting that clients moderate their return expectations down to perhaps 3.5% to 4%, rather than the near 5% gross returns we've received in the past. We think there will be plenty of reasonable fixed income opportunities in 2020, and we look forward to bringing these to our clients. Last financial year was a difficult year for listed investment companies, thanks for the most part to Labor's negative franking credit policy heading into that May federal election. I'm pleased to report that many of these have staged a significant recovery in the back end of this year, and they're recovering back to their fair values. These investments have generally been very high dividend payers over time, and this has broadly continued in 2019. Looking at the outlook for 2020, we think it will be more of the same, with interest rates likely to stay low, and this will be supportive of share markets. In the long-form video, Will Douglas explains how lower interest rates force investors up the risk curve, and why this is supportive of share prices and even fixed interest prices. In very simplistic sense, when the returns on offer in cash and term deposits fall, people need to take on higher risk in order to receive their return, or in order to maintain their return objectives, essentially. Look, we've shown this chart above in many of our economic updates, as we think it's a good representation of how the economic cycle progresses. Right now, we think that we're moving from the recovery phase into the overheat phase. So we think markets will be supported higher by lower interest rates, but ultimately we think they might overstretch. We may start to see more speculation and more irrational exuberance through this period, so it will be very important that investors maintain a level head. Volatility will no doubt continue to rear its head as the US-China trade tensions rise and fall from month to month. We also have this very big ticket item coming at the end of next year, the US federal election. So while we're broadly positive, just continue to expect some bumps in the road. From the team here at Morgans, thanks to all clients of Hyland Financial Planning for a great year. We sincerely appreciate our working relationship, and we look forward to a prosperous year ahead and a great decade to come. All the best for a happy and safe period. Thanks very much.